Hey Daniel, how you doing today?
I'm doing well, Jan. Loving this video series. Have a very interesting topic today. Tough environment, but it's like living history. It's you read history books, and sometimes you have to read for decades to experience stuff that we experience in a week nowadays.
Well, I think that's just because you're getting older and you've experienced enough stuff in the past few decades that it only seems that way. We've gone through quite a bit, but we had actually had a hard time narrowing down what the topic was going to be today. And I think that because the last time in our video we talked about modeling out or showing the progression of how to build a scenario, we're going to kind of go through that today a little bit with some real life examples or practical examples, I should say, that anyone can use for their work with their clients.
Yeah, absolutely. I think that we're living through a scenario that many people don't realize the full repercussions of possible consequences of what's going on now. We're seeing the Fed really supposedly intent on raising the interest rates very significantly, maybe by another 200 basis points from here, maybe more. So the news came out today, though, that there's some leak or something that they're not going to do 1%. So they're not going to do 100 basis point interest rate hike. So they're not going to follow Bank of Canada, which did 100 basis point rate hike, which in my opinion is extremely dangerous in this environment. We're actually not in a very strong economy to be doing these things. I think that central banks have missed the window. For whatever reason, they didn't do this when they could, and they're doing it now. But the Fed's not going to do 100 bips. But according to the minutes of the meeting, of the Fed meeting that were released, there's a lot of hawkishness, and they're definitely going to do 0.75% at least. So they're not backing down. There's a lot of, there's some pain in the markets that today is actually an update because there's no 1% move. But so people are following these local, events. Okay, Fed moves rates, stocks down and up, and this kind of roller coaster thing. But what we should talk about is, for your clients as a financial advisor, how you should think about the situation. What possible dangers does it present? Because we already talked about risk management is not about predicting future, but it's rather about thinking systemically about the type of portfolio that your client owns and the type of shocks it could possibly experience, right? So last time we talked about some shocks related to the Federal Reserve. Now we're going to talk about the same thing, but from a different angle. And I'm going to show viewers my screen, which is really just the yield curve, right? Current yield curve.
Yeah.
And the dark blue, the thick blue line is the current yield curve. So you can see that at 1 year, it's about 172. I'm sorry, at 1 month. At 1 year, it's already 3.17, 3.18. And then it's sort of flat, actually. So at the 30-year rate, it's 3.1. So you could almost, you could see what's happening here. When we think of the yield curve, bond traders, they always think about different shapes of the yield curve. There's a lot of poetic names to that. So sometimes they call it like a twist. So a curve, twists. Sometimes they call it a butterfly. So like a butterfly flapping wings. So you can see this line. There's really a lot of different types of moves that historically have happened for different reasons. What I want to talk about today is, for your clients as a financial advisor, how you can think about possible interest rate moves here. And we'll show you how exactly to model them, how to model them in the stress testing tool. We'll use portfolio crash testing, which is our financial advisor stress testing tool. If you have other tools, you can try to build that scenario. So what we are seeing here in the orange dotted line is the yield curve as it was 6 months ago. Notice how dramatically different the shape of the curve is. Essentially, what we see kind of a dotted line 6 months ago, that's more or less normal yield curve. And typically it'd be a little bit, the long end will be a little bit higher. So it typically starts lower and then goes up higher. That's the normal shape of the yield curve. The longer the horizon is, the more you expect in return per year for locking your for lending money. But we see what happened with this blue line. Very interestingly, the short end kind of goes up, right? So it goes up very steeply. It's like like a cliff, and then it goes flat. So that's already happened. But as a financial advisor, thinking about the future, what could happen going forward? And besides the Fed scenarios that we discussed in the last video, please go wherever you're watching, look at the previous video. You can check it out if you're watching on our RiXtrema blog, rixtrema.com/blog, where we put all our research. You can go there and find the previous video. If you're on SoundCloud or iTunes, you can look for the previous podcast. But the idea with the scenario we discussed was the Federal Reserve actions. Now we're going to take a little bit more closer look at the consequences with the yield curve. In the next video, we'll take a look at the dollar. So with the yield curve, we're seeing this move where instead of the upward sloping kind of sideways line, we have this I would say this is like a letter L that's turned around and on its side. So the short end of the curve goes up very, very quickly from 1 month, 1.7%, to a 1 year, 3.1%, extremely steep increase. And then it's sort of flat. It moves around a little bit. So if we were to model a further step, what I would suggest to financial advisors is to think about inverted yield curve. I'm not saying that it will happen, but we're clearly seeing a move that's similar to inverted yield curve. So normally your yield curve is when longer rates are higher. Inverted yield curve means that the shorter rates are higher. An inverted yield curve typically associated historically with recessionary expectations, at least, right? And we already said in the last scenario that we believe we are entering a recession already. I mean, there's a lot of signs for that. So if there were an inverted yield curve, what would happen here? So a 1-year rate will go up even higher, while a 30-year rate would go down symmetrically, right? That's one of the possible ways of yield curve inversion. So instead of this flat line from 1 year to 30, now we would have a steep line, somewhat steep line down from upper left corner to lower right. And I think that this is a scenario that you need to watch as a financial advisor. Again, our show is for sophisticated financial advisors who want to be risk managers for their clients, because you have to be a risk manager, right? As Ben Graham said, management of investment management is really management of risk, and that's what we're doing here. So, Jan, with this idea that we're going to try to look at the inverted yield curve today, what are your thoughts? I'm going to stop the screen share. What are your thoughts? How would you model this? What would be the consequences, and how would you, frankly, position the portfolio if you're worried about such a scenario?
Well, I mean, if you look at what, there are really two ways to get this inverted yield curve in very simple terms, right? The long end falls further from where it is and everything else stays the same. That would invert it, right? Because we're basically flat right now. For those of you listening on a podcast, we basically have a very, very steep short end from 0 to 1 year, where it goes from, I forget what the exact number was, but up to 3%.
From like 1.7 to 3.2, essentially.
Yeah, looks like a cliff. I mean, essentially, it's almost a exact vertical line. And then you have essentially a slight downward slope to the 10-year. You have this weird bump at the 20-year, which, I'm not quite sure why the 20-year always seems to have this, irregularity in it. I'm not sure if it's because of liquidity or whatever. And then back down to the 10-year, which is almost the exact same level as the 2-year. So if you picture that in your head, you can have the 30-year fall, 100 basis points, call it, which would likely drag down the 10-year and some of the 5-year points and things like that. And you'd have this downward sloping yield curve. The other way to get it is you can have the short end continue to rise. And because the Fed is giving all indications that they're going to continue to raise rates, essentially that's how we got in this position in the first place. The short end is going to have to go up because the Fed is raising, that very, very short end. And it's going to continue to increase, at that very short end of the curve. And even if the long end of the curve stays exactly where it is, you're going to get that inversion because that's kind of anchored where it is, and the short end continues to go up. And then, of course, you're going to have a combination of the two, which would be a more dramatic steepening, and we'll look at that in a moment. But as far as how you'd position a portfolio, any time that you think the long end is going to do well relative to the short end, you're going to want to be you're going to want to have some duration assets in your portfolio. some longer duration assets. And it's kind of counterintuitive in a way when you think about the Fed raising interest rates, all rates should be going up. But, if you're talking about an inversion, your safer point is going to be on the longer part of the curve, and you're getting some, reasonable compensation for that,
And we'll show some examples of, what could be in the portfolio, but we're in a scenario where the Fed does a couple of things. They're raising very aggressively the short end. That itself has a major impact on the world economy. It creates, first of all, attractive, there are no assets in the world that have a yield comparable to the short treasury with that kind of risk. There's nothing out there. So capital flows there. Now, at the same time, this increasing of the short-term rates, it impacts the dollar in a big way. And we'll talk about in the next show how you should model dollar moves for your clients. So the dollar is gonna, the high value of the dollar is going to cause recession no matter what, globally. Banks will be insolvent. I don't know if you know, in China, Jan, there are massive lines right now. Some banks are simply not giving out money. They have not enough deposits. They're saying they're doing system upgrades for a week now. And this is China, not the weakest economy in the world. So strong dollar has major impact. And what does it do when it creates a risk environment? People pile into the short treasury even more. So we have this kind of a very interesting dynamic. Now, all this in itself causes a recession if the economy is vulnerable, right? If the economy was strong, it would survive it and move forward. But if the economy is vulnerable, which it could very well be, I think it is, it will cause a recession. Then the long end of the curve will drop. So it's almost like this is a scenario that's quite plausible because the Fed's actions seem to be, leading to it.
Yeah. So we'll see if the scenarios are right. But, as we've discussed in the past, the important thing is not to be right about your scenario. The important thing is not to say, I know that the short end is going to go up by 100 basis points and that the long end is going to go down by 30 basis points. The important thing is to look at what could happen with this inverted yield curve and what would happen to your portfolio in that scenario. It's never that, we believe it's going to be exactly 100 basis points up and 100 basis points down on the long side. The idea is to see how your individual assets and how your portfolios will perform, or your client portfolios, I should say, will perform in those types of environments.
Yeah.
So maybe we should just jump in and take a quick look.
Let's do a bit of a modeling for our podcast listeners. We will, try to kind of verbalize everything that's on the screen. It's not that hard because we're going to keep it simple in these videos. Portfolio crash testing is a software that we use. This is RiXtrema software for advisors. You can get a demo of it below the video. There's a link, or rixtrema.com. But we're going to use very simple scenarios here. So go ahead, Jan.
Yeah. So the portfolio that I have loaded here is a diversified portfolio. Now, I'd expect that this is something, maybe similar to what some of your clients might have. I did it with, I have a combination of ETFs, bonds, and stocks, and we even have a small Bitcoin investment trust and some more unusual things. But for the most part, this is just ETFs, bonds, and stocks. Okay. And what we're going to do is I have three factors loaded here: the 1 year US government curve and the 30-year US government curve. And I also have the US equity markets, but we're going to concentrate on the 1 and 30-year US investment curve. And the reason that I have the US equity markets is because, just like with so many of the scenarios that we talk about, whether it's like, increasing gas prices or some other commodity, these scenarios have possibilities to have different effects on equity markets than you might be that might be shown by just the normal correlations behind the asset. So, for example, the easiest one is gas prices. Gas prices can rise because of supply or demand constraints, and those two scenarios would have very different implications on U.S. equity markets. So you can't really just shock gas prices without having a scenario in mind that would have a resulting shock in the United States equity market, for example. And so you really need to kind of think through most of these scenarios in ways that are more nuanced than just say, we're going to shock a single factor. But for right now, we are just going to shock two factors, and then we'll bring in the United States part of it, and we'll discuss it on the way through. But I think what we want to do first in this shock scenario is we're going to put the 100-year government curve up 100 basis points.
1 year,
and
right?
the third, right? And the 30-year down.
Yeah, you said a 100-year. I think there actually are some 100-year treasuries, but it's a 1 year.
Did I say 100-year? Sorry, 1 year, 100 basis points.
Yeah.
Is what I meant to say. And then that's going to go up 100 basis points, which in our system is just a 1. And the 10-year is going to go down, or the 30-year, I'm sorry, is going to go down 100 basis points.
Yep, 1%, exactly.
And so what we have in this scenario is with this particular portfolio, and again, this result is really sort of irrelevant to what this to anything that we're talking about. But the result of this portfolio is that it would be up 1.13%. Now, I haven't done anything with the United States.
Why would that be interesting?
Yeah, exactly. And that's what we want to talk about, because this is the result of this portfolio is not the important part. The important part is the logic of what we're doing and why we're doing it. If you look at this portfolio, I have some, I mean, what is that? A 21-year bond that is actually doing quite well, because why? The 30-year is falling, meaning that price is going to increase on that bond. I have a 30-year bond there. I have a 15-year bond, and I have some longer-term bonds that are really helping
they're basically saving your portfolio. So in other words, the 60-40 is not a 60-40. It depends on what the 40 is, right?
Absolutely. I mean, that's, if you think back to what the presentation that I did in our risk challenge sessions, I had 3 exact 60-40 portfolio where the 60 was only the S&P and the 40 was changed, and they were drastically different risk profiles. In some ways, the diversification and the allocation of your fixed income portion can have a lot more impact on how your portfolio performs in these than simply, going from, the S&P large cap to small cap or something like that. I mean, obviously that will have an effect as well.
Yeah, you have to be familiar with fixed income, with all these terms we use if you want to navigate these waters going forward. That's for sure.
Yeah. And not surprisingly, Daniel, we see that the S&P is down. So I have a SPDR ETF in my portfolio, and we see that is down here, right? It's down quite a bit.
It's a big red line. So these are on the right, these charts are the contributors. So these are how different parts of the portfolio will move in this scenario.
Exactly. So the contributors of the down are the S&P 500, which is the biggest holding in my portfolher. The Vanguard MSCI ETF, which is a much smaller, which is still a large holding, but smaller. Another equity portfolio, and then some very short-term bonds, right? So why are the short-term bonds going down? Well, we increased the 1-year part of the curve by 100 basis points, meaning that those are going to get hit from a price perspective. So it makes a lot of sense that these things would fall. But because I have so much different fixed income on the long end in my portfolio here, that's really saving this portfolio. Now, is there anything else that you wanted to add here, Daniel? Anything else popping out at you?
Well, I think just to point out that a good analysis accounts for correlations. Notice that we didn't shock any equities. We didn't shock any credit. We didn't shock any energy. We just did interest rate shocks. But the way the model is built is it propagates correlations. So it will tell you what happens to S&P. It tells you what happens with MSCI EFA. If we had, commodities in there or something, it would tell us that as well. So let's say that if we had gold, we don't have it, which is another topic for one of the sessions coming up. It would probably be down somewhat because it's closer related to the longer end of the curve, being kind of an inflation type hedge. Yeah,
and what's interesting is I actually do have Olympic steel in here, which would essentially be quasi commodity play on steel prices, and that's up slightly, as well as emerging markets being up slightly. And so I mean there are some interesting things about this, saying
But MSCI EFA is down though.
But MSCI EFA is down, but the emerging markets are essentially flat. We'll call them flat. They're not.
Right. They're about flat. Yeah, here.
They're about flat. And so one of the things that we can do here, well, we can do 2 things. One, we could say that the U.S. government curve, let's just say, we had that scenario that we talked about, and that the government that the 30-year curve is only down, 10 basis points. So it barely moves. We get a very different outcome here. We actually, it actually becomes more positive because it implies better price moves for equities. It implies less of a flight to safety, right? We're not, because what you talked about is if we have this recessionary environment and stocks, recessions, generally speaking, stocks decrease. I think always speaking, I'm not sure we've had many recessions where stocks are up. I'd have to check the data on that, but basically by saying that, we're not having this flight to safety on the 30-year side, we're just we're getting this inversion, but we're not getting a decline on the 30-year price. That's a good sign for equities. In that case, it means that
you could have a stagflation, which is a kind of a recessionary scenario where stocks are flat. We discussed that in our last video in detail, the stagflation. But here, the point to take away is that you have a 60-40 portfolio. It's not just 60-40. You should understand that being exposed to long duration has some benefits in this type of a scenario. But again, you need to do comprehensive stress testing. For example, if you add these long bonds in a portfolio to protect against this scenario, you need to think about which ones, and you also need to think about, well, how will it play in other scenarios? That's why when we do stress testing, we call it portfolio crash test, which is a number of different stress tests. So these long-term bonds, for example, are not going to do well in an inflationary scenario, right? So they're not. So then I guess you have a couple of choices. You either not get that insurance for the type of yield curve inversion, or you keep it and then you add something that does well in inflation, right? You can, whether it's tips or gold, or some other type of commodity that can do well in inflation, right? So you will be then having a portfolio that can perform, that can perform its task in different scenarios. That's
right. You have to have those base scenarios that you think are going to happen. I mean, I think it's pretty safe to say that the short end is going to go up, right? I mean, this is not there can't be.
I don't know what has to happen for the Fed to back down at this point and say. A lot of analysts saying they will have to drop it, and we have scenarios for that too. You should run all stress tests, all possible ones, but it seems highly unlikely that they will at this point.
At least in the short term, right? I mean, once you start to get that recession coming, like once that data starts to come in, there's signs that recession is coming or could be coming, but it hasn't. But we're not in recession technically, right? So the Fed, when you have job growth like we have, or job, new hires like we have, the Fed's going to look at some of that information and say, we're still growing. Now we're starting to get some earnings reports that, already today, two banks, JP Morgan, I forget the other one, reported, and they reported pretty disappointing results. If that continues, that's kind of a first, maybe a sign. And the strong dollar for these global banks, these global assets, global companies are not. Strong dollar is not a positive sign when you get a significant amount of your revenue overseas, right? Because for obvious reasons. So,
but for global, for example, why banks in emerging markets will be in trouble is because all of a sudden they have to mark up their assets. All of a sudden they need to get more liquidity, more liquid assets on their balance sheets, and this is causes like a vicious spiral. They have to sell some stuff to become more safe. So it's like everybody's running for that door, but the door's kind of narrow.
Yep. But the last thing I think we should say here on this, Daniel, before we go is this U.S. The reason why I put this in here is that this really is an important, United States equity market, or really any equity market, but because all of our listeners, or most of our listeners, are probably in the U.S., we're going to stick with the U.S. Theme here. The United States equity market is going to be an important point. So I put it back to the original inversion that we had, which is short end 1 year up 100 basis points, 30-year down 100 basis points. And now we can start to see, well, what happens if we do something with the equity markets? I mean, do we think that we have another 10% in the cards here? Well, that drastically changes what happens to these portfolios, to these assets, right? All of a sudden, we don't have very much going up anymore. All of those other things like
But
Olympic
still, those
steel.
long duration bonds are protecting or cushioning.
Oh yeah,
They're large
absolutely.
green lines. They're doing well for you. If you didn't have them, then you'd be you'd be losing much more.
That's right. And those are relatively small positions if you look at them. I mean, this is a 3% position. I have a 3% long bond position that's kind of carrying some weight here, quite a bit of weight on the positive side. So, these are things that, again, this is sort of the way that you just go through and think about your portfolio and think about how the scenario or possible scenarios are going to impact. If you think that, maybe we're going to do this inversion and there's going to be a kind of a dead cat bounce, if you will, or some sort of bounce, well, you can see that could bode very well for this portfolio. I mean, that's a huge gain for a portfolio like this. So these are things that you play with. I mean, if you look back to 2008 and 2002, with the tech bubble bursting, the first warning signs, like we've seen, year to date, we've kind of seen this, slow progression, sometimes a little more rapid in equity markets down. If you are going to be in a recession, if you are going to have this hard or soft landing, it doesn't happen all at once, right? It tends to start to happen. The markets process it. You get kind of a rally, which we've seen some signs of, but not much. But that could happen, and then you get the further leg down. I mean, the recession and the negative moves in 2008 started in 2007. We didn't get any major moves down until late 2008. In September and October, those are the two biggest moves, and then again in 2009. So these things can take a while to play out, to get into the market psyche, to really understand what's happening, because everything's moving rapidly.
Yeah, and we're progressing. Right? Last video we did stagflation, we did excessive tightening. Today we talked about inversion. Next session we'll talk about the dollar a little bit more, then about commodities and gold and so on. So you have to have a comprehensive look at the picture. Wherever you're watching this, subscribe. If you're whether it's YouTube or we're now on TikTok, I'm told. I'm sure lots of financial advisors use that platform. So but it got 700 views in day one, right? The first video on TikTok. I don't know who,
how or why we even put it there, but
yeah.
Somebody.
Maybe we need to add some pranks to our repertoire.
I think if you start dancing, you can come up with a dance, Daniel. That would really add to our TikTok.
Yeah, we will just go down. Our views will invert completely. So, subscribe if you're on SoundCloud, iTunes. Subscribe. We're going to be doing this every week. We're going to go over different scenario, different risk management tip. Subscribe. Also, there'll be a link below somewhere if you want to look at portfolio crash testing for your clients, being a financial advisor, how to model stress tests and risk. We can show it to you. You have a great team that does it, but we'll see you next week to talk about the dollar strength and what it means for the portfolios and for your clients' portfolios.
All right. Take care, everyone.
Bye.
Thanks for watching.
Everybody. Bye.